Hello and welcome to our Portfolio Matters edition of Investment Strategies. We included our investment strategies in probably the very first Portfolio Matters video that we prepared, but we're aware that many of you won't have seen that. So we thought we would run through fairly briefly what our strategies are, so that put into context our comments in our weekly updates and our share talks. So before we start, it's over to Keith to read the disclaimer.
Thank you, Richard. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making decisions regarding any topics mentioned on the show. A full disclaimer can be found at the end. Richard, over to you.
Thank you, Keith. So my investment strategy, well, it requires 1 or 2 hours a day reviewing news, listening to podcasts, or reading some newsletters that I subscribe to. My trading style. So I thought this was quite opposite, actually. I am an alcoholic. I haven't had a drink for 2 years. Or I am an overtrader. I haven't overtraded for a week. So my inclination is to trade, to be an overtrader. I am a useless trader. Every time I try it, I lose money. And as an example, I was thinking the other day, there's Pensana and Rainbow Rare Earths, and it'd be perfectly possible to switch between the two. One goes down, so you sell it, and you buy the other one that's just gone up, which then goes down whilst the one you've sold has gone up. So my view is that you may well be right in your thesis, but things will take a lot longer than I think, and I have to be slow in my process and slow in my trading. I would also say there's no such thing as a free lunch. You do need to pay for information, for newsletters, other information sources. And a lot of what you read in the newsletters is wrong, but occasionally you'll come across, or not useful, but occasionally, sometimes you come across a little nugget, and those little nuggets pay for years worth of your newsletter subscription. And I just thought I'd say, our goal here at Portfolio Matters, I think, is to help to inform and to stabilize people's investment process. So successful investment requires some sort of reasonably accurate prediction. So you have to understand the timescale of the prediction. My predictions are always a long term, and you'll gather that really from the things we talk about. You have to have information pertinent to the time scale. There's a lot of instant information flying around, which actually is not relevant if you're investing over years. It is relevant if you're investing or trading over 5 minutes or a day or whatever. And then you have to have an idea as to what is likely to benefit from over the timescale you're looking at. So as a private investor, I'm under no performance pressure, so I can take a long-term view. If I have a bad few weeks, bad few months, I don't like it, it's uncomfortable, but I'm only responsible to me. I have to understand my own psychology as it relates to investing. Well, I hate losses, and I want to try and get out of things quickly if I make a loss, but I'm investing for the long term. If I'm investing for the long term and the share price moves in the short term, it should be irrelevant. So if I try and trade short term, my thought process and my trading aren't aligned, and it fails. I don't make money if I try and trade. And my time scale, probably something like 2 to 5 years. So having said all of that, if the thesis changes, if there's some news that comes out that says I thought a company that I thought was a good investment actually for some reason isn't, then I will get out of it. So I don't stick to the 2 to 5 years if the news fundamentally changes, but I try very hard not to react to day-to-day changes that aren't relevant to my timescale. I think that probably does it, Keith.
Okay, thank you, Richard. Okay, my investment strategy. And like Richard, I spend probably a couple of hours a day on this. And actually, you know, frankly, since we've been under lockdown, a lot more because there's nothing else to do. And when we come out of lockdown, then probably the postings on our channel will sort of slow down substantially as our lives return. But anyway, like Richard, I do pay up for some information services, but not many. I pay up for the FT every morning. I pay up for the Investors Chronicle, and I pay for Stockopedia. And the idea there is really to source ideas and to try and come across companies that I'm not aware of, rather than to source by tips, which frankly, the Investors Chronicle have a terrible history of regarding my personal portfolio. And anyone who's seen the My Worst Trades will spot a recurring principle that they've been tipped in the Investors Chronicle. And anyway, it's a lesson learned. When you see some of our share talks now, you'll see in the positive news section that it's been rated a sell by the Investors Chronicle. So I now regard an Investors Chronicle sell tip as a buy signal. Anyway, so to understand my investment approach, I think you have to understand the general principles that I abide by when constructing my investment approach. So number one is, as a private investor, I have no information advantage. You know, the sources of information I buy in, they are secondary compared to the primary source of information that market makers and banks have. So I don't do any deep analysis of company accounts because A, it's not really my skill set. B, it's difficult and time consuming. And C, it's largely unrewarding. And because if you look at Tesla, I don't think what's in the company report actually matters very much at all. And in order to find something rewarding in the annual reports, you need to have a nugget of information that nobody else has spotted. And as there are lots of banks and analysts who spend all their time going through company reports, I think that is very, very unlikely. You also have no access to the management, apart from publicly available podcasts and videos. And from my personal experience, attending AGMs is a total waste of time. So, as a private investor, how can you try and predict what is going to happen in the future, which company is going to do well? And actually, I think the only advantage you have is you can concentrate on the long term. And so I concentrate on predictable long-term trends and cycles. So you will see from my weekly reports and activity reports, I largely trade in oil, commodities, and business cycles. So I'm looking at oil companies because I look at the oil cycle, commodity companies because I'm looking at the capital cycle in copper and commodities, and the business cycle. So I'm looking at cyclicals. Are we near the bottom of a cycle or near the top of the cycle? And that means that, like Richard, I have a long-term view. Now, what you'll see in the portfolio is that there will be times when I'm very busy. So right now, we are kind of in the bottom of a cycle in terms of the business cycle, and I've been moving out of some safe havens such as gold and moving into cyclicals. But going forward, once those trades are complete, I fully intend to just sit back and watch the portfolio. And there will be a bit of spivvy trading in and out of some dodgy companies just to keep me entertained, but largely the portfolio will be stable. So, you know, right now we are producing quite a lot of stuff and the activity reports are busy. They will become less so. The other thing is, and I can't emphasize this enough, equities are dangerous to your wealth. I mean, since I've been investing, which is sadly 30 odd years now, I have been through lots of nasty market downturns. And frankly, the reason that my portfolio has done well is that I've managed to avoid, I think, most of the really nasty downturns by getting out early. And that meant when I thought the market was frothy, I moved to cash, I moved to bonds, and I was prepared to sit for 2 years waiting for the market to decline. And having cash and liquid assets at the bottom of a cycle is really important, because we have a very indebted system. When there's a spike in volatility, there is forced deleveraging. So a downturn in equity markets forces sellers, which exacerbates volatility, which forces the market down. And if you have the cash to buy equities at ridiculously low prices, you can make out very well. And so when you look at my performance last year, I bought a chunk of equities at the lows in March. So don't underestimate the optionality of cash. You can't hold it forever because you lose money versus inflation. But at times in the cycle, the safest place to have your money is in cash. So with those principles in mind, my investment strategy is to play the cycles. So it's very much top down. I'm not trying to analyze company reports and look for individual opportunities. What I'm trying to do is look at the macro economy, say, well, there's a lot of money printing, commodities will do well, etc. And then from that, it follows that I should be looking at commodity companies, and within those, I'll try and find the ones that offer the best opportunity and value, but I spread it around. There's a lot of idiosyncratic risk in individual companies. For example, we covered the gold miner Centamin, which has instability in its mine, and the share price fell a third. And those sort of situations are absolutely unavoidable at a portfolio level. So you want to have a well-diversified portfolio that gives you exposure to the sectors you are after, while trying to keep the individual stock risk under control. So what you'll see in my portfolio, I largely ignore sectors which have strong competitive pressures and where there isn't a cyclical component, such as food retailers or telecoms, etc. And I watch the cycle, and when I think it's peaking, I like to get out and move into cash or liquid defensives such as bonds. And that absolutely requires market timing. So, I mean, the big difference between the way I manage my portfolio and the way private investors are often recommended to manage their portfolio is I very much try and time the market. I try and time when to get into equities and when to get out. And frankly, I think if you follow these cycles, that is not impossible to do. And I've largely been successful in doing it, although you do have to be nimble on your feet when cycles turn much faster than you are expecting. Richard, is there anything else you'd like to add?
Well, there's a couple of points I'd like to make, Keith, perhaps at the end. So if I share my screen again. So the other things I wanted to add, Keith, ideally I'd like to have more than one theme running simultaneously. Because when you're looking at a theme that might take quite a long time to pay off, running several themes allows them to stagger, and your whole portfolio isn't entirely dependent on one theme. And I think psychologically that makes managing the portfolio easier. I have to say, from personal experience, it's almost certain that any share I buy will fall immediately I buy it. And you just have to ignore that and stick with the thesis. There's so much trading in the market that by definition, most sellers of shares are short-term holders. I'm operating a long-term portfolio. And so the actions of short-term holders should be largely irrelevant to me, which is why you shouldn't respond to the short-term changes in price. having made the decision and having built up the portfolio of whatever holdings I feel reflect the investment thesis, monitor the thesis for its ongoing validity. Do be prepared to change your mind. Don't be so wedded to it. Monitor individual stocks to ensure nothing has changed in their ability to reflect your thesis. And if necessary, change the stocks that you own if more information becomes available. Don't continually try and move to the highest performing share in the sector. All that happens then is you end up with churn in your portfolio. Don't perform multiple trades. Try and stay calm with your thesis, and then do allow your thesis to play out before entering the next one. Otherwise, you may, because timing is so difficult, you may be out by a year. The thesis may still be relevant. You think there's a better one. You move out of the one you were in, that then plays out, and the better one sits there doing nothing for 3 years. So you have to have the patience to sit it out. And if you follow this process, you will start possibly with a fallow period where basically nothing is happening.
Yeah.
You have to give yourself time to develop the portfolio that you want.
Yes, that's a very good point, Richard. Actually, one of the things that I am aware of with starting this podcast is it forces me to actually look at the portfolio probably more than I'd like.
Yes.
And it's then tempting to trade more than you should, and that is something I'm very aware of. Actually, can I just ask you, the big difference between your portfolio and mine, or one of the big differences, is your exposure to Bitcoin. Now, how does that fit in with your investment theories?
Well, I first bought Bitcoin about 4 years ago, and actually various other altcoins. So I went through some of that peak, and I went right the way through the trough. Now, I did exit some positions at the peak. I held a lot of my Bitcoin, Ethereum, and a couple of altcoins all the way down the parabolic drop and along the bottom. And actually, about January 2020, I thought that they were going to go up, that they had bottomed and that they were going to go up. Now, I didn't buy at the bottom, but I was buying them in January, February, and March. And I bought them at just a little bit at a time. And so my timing was lucky, and I have held them since then. I have got a sort of rough start to take profits point in my mind, and we're not there yet. So what I haven't done, and I haven't sort of bought, sold. I have dripped a little bit of money in now and then, but I am sitting on my hands as much as I possibly can. The other week I mentioned that I moved a little bit out of Bitcoin into Ethereum, but apart from that, I'm really doing nothing. And it is very tempting to bounce around, and I'm not doing it. But I don't think it's, for me, it's not a 5-year hold, but it might be another 12 months or so.
Right. Okay. Very interesting. So what percentage of your total portfolio is Bitcoin and crypto?
Well, it's around about, say, 8%.
Right. Okay.
But that's now. So
Yeah.
it was less, obviously.
Yes. Well, very good.
That's an interesting point, though, Keith, isn't it? Because at some point, the size of a particular exposure can start to threaten the stability of your portfolio.
Yes.
So if something regulatory happened to cryptocurrencies tomorrow, I would now take a much bigger hit than I would have taken a year ago. And that's important to be aware of that and not to let it get too big to the point where it can destabilize your portfolio if something adverse happens to the valuation.
Yes. At the same time, which is quite a nice problem to have, isn't it? Yeah.
Yes,
anyway, so if you enjoyed that, I hope you will dig out our first opening introductory podcast where we cover these topics in some depth.
Yes. So, goodbye from Keith Jordan.
And goodbye from Richard Wheater.
Goodbye.
And press like, subscribe. Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.